Look, I'm not a doomsday preacher. I'm just looking at the data. And what I see right now should concern every single person watching this video. We're sitting on $957 billion in commercial real estate loans that need to be refinanced in 2025. That's nearly triple the 20-year average. And here's the kicker, most of these loans were written when interest rates were at 2 to 3%, and they're being rolled over at 7 to 8%. But that's just the tip of the iceberg. When you factor in the $337 billion in unrealized losses sitting on bank balance sheets as of Q3 2025, and the fact that regional banks have 44% of their entire loan portfolios exposed to commercial real estate, you start to see the contours of something much larger. Something systemic. And gold just hit $4,561 per ounce. Silver broke $78 for the first time in history. These aren't random numbers. These are warning signals. Why now? Why is early 2025 to mid-2026 the danger zone? Three things converged at exactly the wrong time. First, the Federal Reserve held rates near zero from 2020 to early 2022, encouraging massive borrowing in commercial real estate. Office buildings, shopping centers, apartment complexes, everyone levered up at 2 to 3% interest rates. Second, the work-from-home revolution gutted office demand. National office vacancy rates are approaching 20%. Think about that. 1 in 5 office buildings is sitting empty, generating zero cash flow while the debt service keeps mounting. Third, and this is the critical piece, $1.2 trillion in commercial real estate debt matures by the end of 2025. That's not a problem when you can refinance at similar rates. But when rates jump from 3% to 8%, property owners can't make the payments. Banks can't pretend the loans are good. The music stops. And here's what nobody's talking about, CMBS delinquency rates hit 7.29%, nearly 6 times higher than traditional bank loans. The securitized debt market is already fracturing. Let's walk through the math because this is where it gets real. Imagine you own a mid-sized office building in downtown Denver. In 2020, you took out a $10 million loan at 3% interest. Your monthly payment was roughly $42,000. Your building was 85% occupied, generating $60,000 a month. Life was good. Fast forward to 2025. Your loan is maturing. But now your building is only 60% occupied because of remote work. Your income dropped to $42,000 a month. And the bank says, sure, we'll refinance you, at 7.5%. Your new payment? $70,000 a month. You're generating $42,000. You need $70,000. The math doesn't work. So what do? You default. The bank takes the building. They try to sell it. But who's buying a 60% occupied office building in a rising rate environment? Nobody. The bank takes a 40 to 50% loss on the loan. Now multiply that scenario across $957 billion in maturing loans. Even if only 20% of these loans go bad, and that's conservative given current conditions, you're looking at $190 billion in direct losses to the banking system. But here's the thing, it's not distributed evenly. The big banks, JP Morgan, Bank of America, they have only 13% exposure to commercial real estate. They'll survive. But regional banks? 44% exposure. When those CRE loans start defaulting, it doesn't just dent their capital, it wipes them out. Remember Silicon Valley Bank in 2023? That started with a $1.8 billion hole. Imagine that happening simultaneously across dozens of regional institutions. Now let's talk about what the regulators don't want you to see, unrealized losses. As of Q3 2025, U.S. Banks are sitting on $337 billion in unrealized losses on their securities portfolios. That number actually came down from $395 billion in Q2, but don't let that fool you into thinking the problem is solved. What does this mean in English? Banks bought government bonds and mortgage-backed securities when rates were near zero. A 10-year Treasury yielding 1.5%. An MBS yielding 2.5%. Safe, right? Wrong. When the Fed jacked rates up to 5%, the market value of those bonds cratered. A bond paying 1.5% isn't worth face value when new bonds pay 5%. The banks are holding these securities at book value on their balance sheets, but if they had to sell them tomorrow, they'd take massive losses. $221.8 billion of these losses are in held-to-maturity securities. These are bonds the banks claim they'll never sell, so they don't have to mark them to market. But what happens when depositors start pulling money because they're scared about CRE defaults? The banks have to sell those bonds to raise cash. And suddenly, that $221.8 billion in unrealized losses becomes very real. This is exactly what killed Silicon Valley Bank. Not the loans, the securities portfolio. And right now, that same dynamic is loaded into dozens of regional banks like a coiled spring. Here's the insider activity that should terrify you. In Q2 2025, before the latest FDIC report came out, executives at 3 major regional banks sold a combined $47 million in company stock. That's not normal portfolio rebalancing. That's people who know what's in the books getting out before the market figures it out. Okay, deep breath. This is where it gets scary. The global derivatives market is valued at over $700 trillion in notional value. Now, the actual risk exposure is much smaller, maybe 2 to 3% of that notional amount. But even 2% of $700 trillion is $14 trillion. That's the size of the entire U.S. economy. Here's how this connects to our CRE crisis. A regional bank in Ohio has $5 billion in commercial real estate loans. To hedge their interest rate risk, they entered into interest rate swaps, derivative contracts that pay them if rates go up. Sounds smart, right? But those swaps are contracts with counterparties, other banks, hedge funds, insurance companies. When the Ohio bank starts taking losses on CRE and their credit rating gets downgraded, the counterparties demand more collateral. The bank has to post cash or securities. But the bank's securities are underwater, remember those unrealized losses. So they have to sell at a loss to meet the margin call. That triggers more losses, which triggers more downgrades, which triggers more margin calls. Now multiply that across the entire regional banking system. Suddenly, it's not just about Ohio. It's about the interconnected web of derivatives linking regional banks to insurance companies, pension funds, and hedge funds. In 2008, AIG nearly collapsed because it wrote credit default swaps on mortgage-backed securities. Everyone thought the housing market was safe. When it wasn't, AIG owed $180 billion it didn't have. The government had to bail them out to prevent a complete meltdown. The derivatives market today is 4 times larger than it was in 2008. And the counterparty risk is even more concentrated in a handful of clearing houses. If one major player fails to meet their obligations, the central counterparties get stressed, triggering default waterfalls that hit all participants. As one risk analyst put it, because notional values are so large, even if the actual loss absorption bucket is a fraction, the contagion effects could dwarf previous crises. That's not speculation. That's the mechanics of the system we're operating in right now. So how do you know which banks are at risk? Here are the warning signs. First, commercial real estate exposure above 300% of capital. You can find this in banks' quarterly reports. If a bank has $1 billion in capital and $3.5 billion in CRE loans, they're in the danger zone. One bad quarter of CRE defaults wipes out their capital buffer. Second, high concentrations in office and retail loans. Industrial and multifamily properties are doing okay. But office buildings and regional shopping malls? Those are the categories getting crushed. If a bank has heavy exposure there, red flag. Third, unrealized losses above 10% of tangible equity. The FDIC publishes this data quarterly. If a bank is showing large unrealized losses relative to their equity base, they have no margin for error. One deposit run, and they're forced to realize those losses. Fourth, geographic concentration in struggling metros. Banks heavily exposed to San Francisco, downtown Chicago, or tertiary office markets are carrying more risk than banks in growing Sunbelt cities with diversified economies. Fifth, recent executive stock sales. This requires some digging, but insider selling patterns often precede trouble. When the CEO and CFO are quietly unloading shares 6 months before a crisis, that's a signal. Use sites like the FDIC's Bank Find, quarterly call reports, and SEC filings to track these metrics. It takes an hour of research, but it could save you 6 figures in deposits. Alright, so what do you actually do? Here are 8 strategies, prioritized by importance. Strategy 1. Split your cash across multiple FDIC-insured institutions, keeping under $250,000 per bank. FDIC insurance is real, but it only covers up to $250,000 per depositor, per bank. If you have $600,000 sitting in one regional bank, you're exposed. Spread it across 3 institutions. Yes, it's annoying. Yes, it's worth it. Strategy 2. Allocate 10 to 20% of liquid assets to physical gold and silver. Not ETFs. Not futures. Physical metal you can hold. Gold hit $4,561 an ounce. Silver hit $78. These aren't bubbles, they're reactions to systemic instability. When depositors lose faith in banks, they buy what's worked for 5,000 years. 1-ounce gold coins, silver bars stored at home or in a private vault. Not a bank safety deposit box. If the bank fails, you can't access that box. Strategy 3. Keep 3 to 6 months of expenses in physical cash at home. In a bank-run scenario, ATMs run dry fast. We saw this in Cyprus in 2013, Greece in 2015, and Lebanon in 2020. $5,000 to $10,000 in small bills, stored securely. You hope you never need it, but if you do, it's invaluable. Strategy 4. Diversify into Treasury Direct accounts. Buy short-term Treasury bills directly from the government at Treasury Direct. Gov. No bank intermediary. No counterparty risk. 4 to 5% yield on 3-month T-bills, backed by the full faith of the U.S. government. It's not exciting, but it's safe. Strategy 5. Consider moving deposits to larger, systemically important banks. I hate saying this because I want to support community banks. But the reality is JP Morgan and Bank of America are too big to fail. The government will backstop them in a crisis. Your local regional bank with 44% CRE exposure? Maybe not. Cold calculus, but true. Strategy 6. Set up credit lines now, before the crisis hits. Home equity lines of credit, business lines, personal lines, lock them in now at current rates. Once banks start failing, credit markets freeze. You want that liquidity available before you need it. Strategy 7. Review your investment portfolio for indirect bank exposure. Do you own regional bank stocks? REIT funds heavy in office buildings? Bond funds with CMBS exposure? Those could get hammered. Reduce or hedge that exposure. Strategy 8. Develop alternative payment methods. If the banking system seizes up even temporarily, you need options. That could mean holding some cryptocurrency as a payment rail, Bitcoin or stable coins, or simply having multiple bank accounts with debit cards so you're not dependent on one institution. These aren't radical steps. This is basic risk management. The cost of preparation is minimal. The cost of being unprepared is catastrophic. If this unfolds, and I give it 60 to 70% odds over the next 18 months, it will happen in 3 distinct phases. Phase 1, the initial shock. It starts with 1 or 2 mid-sized regional banks announcing major losses on their CRE portfolio. Stock price collapses 40% in a day. Depositors panic. Bank runs begin, not physical lines but electronic transfers. Within 72 hours, the FDIC steps in, takes over the failed institution, and guarantees deposits. Markets tank 5 to 8%. The Fed issues calming statements. Treasury Secretary goes on CNBC. The system is sound. Isolated incident. But everyone's now asking, who's next? Gold jumps $200 an ounce in a week. Phase 2, contagion. The market starts scrutinizing every regional bank's CRE exposure. Short sellers pile on. Credit default swaps on bank debt spike. Deposit flight accelerates, not just from troubled banks but from anything regional. 3 more banks fail in 3 months. The FDIC's Deposit Insurance Fund, which stood at $128 billion, starts getting depleted. Congress has emergency meetings about backstopping the fund. Commercial real estate prices collapse another 20 to 30% as distressed properties flood the market. This creates a feedback loop, more loans go underwater, triggering more bank losses. Derivative counterparties start failing to meet margin calls. A major hedge fund blows up. The Fed activates emergency lending facilities, just like in 2008 and 2020. Gold breaks $5,000. Silver hits $100. Phase 3, policy response and currency debasement. The government does what it always does, it prints. The Fed expands its balance sheet by $2 to $3 trillion, buying up distressed assets to stabilize the system. Congress passes emergency legislation guaranteeing all deposits, not just the first $250,000. This prevents total collapse, but it comes at a cost: massive currency debasement. The dollar weakens 15 to 20% against a basket of currencies. Inflation, which had been cooling, reignites, hitting 6 to 8%. Precious metals go parabolic. Gold at $6,000. Silver at $150. Not because metals are magic, but because they're the historical hedge against currency debasement. Every time in history a government has printed its way out of a crisis, hard assets have protected purchasing power. This phase lasts 12 to 24 months. Eventually, the system stabilizes at a new equilibrium. Banks recapitalize. CRE prices find a bottom. Life goes on. But those who prepared preserve their wealth. Those who didn't got wiped out. Look, maybe I'm wrong. Maybe CRE defaults stay contained. Maybe banks can extend and pretend long enough for a rate cut cycle to save them. Maybe the derivatives market doesn't cascade. I hope I'm wrong. But here's the thing, the cost of preparation is minimal, and the cost of being unprepared is enormous. Splitting your deposits across multiple banks costs you nothing but an afternoon of paperwork. Buying some gold and silver costs you a small premium over spot price. Keeping some cash at home costs you the interest you're not earning. These are insurance policies. You don't buy home insurance hoping your house burns down. You buy it so you can sleep at night knowing you're protected if it does. The data is screaming warning signals. $957 billion in maturing CRE loans. $337 billion in unrealized bank losses. $700 trillion in derivatives. Office vacancy at 20%. Gold and silver at all-time highs. I'm not a doomsday preacher. I'm just looking at the data. And the data says, prepare. If the crisis doesn't come, you spent a weekend organizing your finances and bought some shiny metal that holds value. If it does come, you protected everything you've worked for while everyone else panics. That's not fear. That's prudence. Stay safe out there.